Hi, I'm David Busch, the Co-Chief Investment Officer at Trajan Wealth. I recently had the opportunity to join FintechTV to discuss markets and the economy. Please check out this video for my insights and don't forget to like and subscribe.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you've got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers.
The Federal Reserve cut interest rates by 25 basis points at the conclusion of its September meeting. Fed Chair Jay Powell saying sticky inflation and worrying labor market data presents two-sided economic risks. As we watch the market open, joining me at the New York Stock Exchange is David Busch, CIO at Trajan Wealth. David, great to have you here. Thank you so much for joining me.
Thank you. I appreciate being here.
Well, there's a lot of anticipation going into the September Fed meeting. We got that widely expected 25 basis point rate cut. But of course, the details from the presser as well as the summary of economic projections. What are the implications and what does it mean for the markets?
Yes, it was kind of an interesting meeting and actually post-Fed, interview. So essentially, the Fed is balancing, right? Labor markets as well as inflation. Mm-hmm. Now we've seen inflation come down from its all-time highs, or not all-time highs, but recent highs. But we've also started to see some softening in the labor market with the big revision. So the Fed's trying to manage both of those variables. But they did say this was a risk management cut, which I thought was telling.
Yeah, I'm glad you mentioned that because I was going to ask you about that term. What does that actually mean?
Yeah, with their dual mandate, right now you have inflation that's persistent, and it's not coming down nearly as fast as they had hoped. But at the same time, with the labor market softening, they have to balance both of those, inflation as well as labor. So I think this was a signal to say, let's lower rates, help the labor market stabilize. Meanwhile, their summary of economic projections, which you mentioned, shows a forecasted growth in GDP and inflation, and a slight rise in unemployment.
Yeah, and as we look ahead to next week, we know we will be getting the revision in GDP figures as well as PCE. And as we head into the month of October, we'll be keeping an eye on those non-farm payrolls figures. But when it comes to the bigger picture here, what are the implications as we reach year end?
Yeah, for investors specifically, the way that I would position my portfolio or what I'm advising is, on the fixed income side, be it that 3 to 5 year part of the curve, lean into quality names, IG corporates, but also add a position to TIPS, Treasury Inflation Protected Securities, to help manage some of that inflation volatility that's likely to come over the next year. In terms of the equity markets, obviously tech has been a big winner over the last several years, but now the market is broadening. So with a positively sloping curve, we would see, financials, consumer discretionary, and materials do well, and small caps. Because lower rates benefit, it's a tailwind for small caps.
Yeah, and while we're on the topic of small caps and fixed income, I do want to shift our focus on to what we saw last year in September in terms of the bond market and the reaction to the Fed beginning its rate cutting cycle at the end of 2024. But what are you seeing right now when it comes to both the short and long end of the market here in the U.S.?
Yeah, on the short end, we'll see that the front end of the yield curve, rotate down. So we'll have a positively sloping curve. Where I can see some risk is those who are buying longer dated bonds, call it outside of 10 years, because that inflation volatility can pick up and cause those prices to change pretty rapidly.
Yeah, and risk means opportunity for the market. So what sectors are you paying attention to right now and why? Yeah,
obviously tech, tech is the wave of the future, so we're going to continue to be invested in tech. But also, I would shift into some value. Dividend payers, and the reason is it's more of a defensive play.
Yeah, and before I let you go, you mentioned value. So what area of the market are you talking about when you're mentioning value? Because we are seeing both elevated levels for growth as well as value, but quite a stark difference when we're talking about mega versus small.
Yeah, so I look at companies that have a 10 billion market cap and above, that pay, cyclically proven businesses that pay dividends. Yeah. And these are companies that have stood the test of time.
Yeah, I think dividend is a key word here. So thank you so much for joining me today, David. I appreciate your insights and your perspective.
Thank you, Remy.
Thank you.